With Fundstrat co-founder and head of research, Tom Lee. Tom, great to have you with us. You're also in the camp that August could be tricky.
Yes, yeah, I think August is tricky because, as Bob mentioned, people are on vacation, so it's more vulnerable to sort of shocks. And I think we're in a period where we're going to be nervous about good news. We don't want a good jobs report, or we don't want strong PMIs, because that brings September hike back on the table, along with the 10-year where it is. I think it's very possible we could have a pretty painful drawdown in the first half.
You've been bullish when others have not been.
Yes.
Through the first half of the year. And now that you see strategists sort of bumping up their price targets for year end, Bob was talking about the extreme bullishness now. Does that make you just worry?
Yeah, I think it's a bad sign.
Yeah.
I think we know the strategists tend to reflect the buy side, and all these price target hikes are chases of a market that's already extended. And then we have August, which is seasonally kind of bumpy, and I am kind of worried that we're going to get some good jobs data, like strong job numbers. People are going to start thinking September and higher rates. Oil's already rising. It feels like it could be pretty messy.
So how do you see the path of the markets going into the fall? The fall is traditionally, seasonally, a difficult period, particularly September, October.
Yeah, I'm sorry. All these things I mentioned are just tactical, because I think the second half is going to be really strong. But to me, it's a broadening of the market. You know, it's more about the industrials really responding to the PMI's bottoming, and it's energy reflecting the rise in oil. And so I think it's a broader market, but we could still finish, over 4,800. Well above it on the S&P.
I mean, we're seeing that today with Caterpillar and Eaton, for example, advancing. That said, Bob just raised that idea of a sort of a valuation ceiling, and the fact that we may be hitting or bumping against it in terms of where PEs are, based at least on the earnings we've gotten so far. Do you worry about overall valuation levels?
Yeah. The reason I'm less worried about valuation is so many clients tell us valuation's a problem. And so when you know that that's already top of mind for clients, then they're already being selective. I think the valuation problem tends to be in the mega cap, in the, X the top FANG, we're at 16 times. That's pretty reasonable for a 4% 10-year. So I think
you're just taking out, although Meta, frankly, trades below many of the others, but you're taking out some of the big guys, and then you get down to 16. Is that a way to justify it, or is it still?
That's how our clients pick stocks, right? Because they don't have to buy the FANGs.
They don't? Really? Don't they all just chase?
If you're indexing, right?
Yeah.
If that's your comparison.
That's right. And then if someone's making a case for FANG, imagine someone's thesis is don't buy it because it's expensive. That you would have avoided it for 20 years. So you can't take FANG and say that's a reason not to own it because it's expensive. They've always been. But the rest of the market is pretty reasonable. So I think there's a reason to own both.
But if valuation is not a worry, then 4% shouldn't be a worry either.
It's not. It puts stress in people's minds, but you're absolutely right. The 10-year averaged 5.3% from 1990 to 2007, and the market's total PE was 18 times. We're at 16 times ex-FANG, so there's still room for plenty of multiple expansion. And, it's a good environment for companies when the bogey's 4% on 10-year, because it also limits competition, right? Capital formation's slow, so the dominant companies actually make more money.
There really is more room for multiple expansion with again, a 4% 10-year. That history would tell us yes?
Yes. Yeah, I know we all think 4% sounds like a nosebleed
Well,
rate.
I remember that area, era, excuse me. And
Yeah.
I remember that stocks did go up.
Yes. It depends on why you're at 4%. If it's purely inflation, where it's not a great environment, but if it's because of reflation, and that's, Stephanie Link mentioned, that's like what Eaton's talking about, reindustrialization in America. That's creating reflation here, but it's creating deflation in Asia. So global inflation is not going anywhere, but I'd rather allocate capital in America and on a 4% 10-year. So I think these are the right reasons for the 10-year to be pushing up. But of course, look, near term, we'd have to see how the market feels about 4%. That's why in August, I do think it gets pretty bumpy.
Finally, I stopped asking you this years ago, but you used to track active managers,
Yes.
and how much they were trailing their benchmarks, which seemed every year they were. Where do we stand halfway into this year, and does it mean there's going to be a lot of catch-up being played?
Yeah, it's not great this year, as you know. There's mechanical reasons, because not everybody can break the cap on what they can own on FANG. But there's a lot that thought this was a hard landing, and they were overweight defensives, which have been horrific. So There's a lot of catching up to do. I know that's going to be the reason we have a shallow correction, whatever, in August. You know, I don't think it's the start of any 10% drawdown, but it could be sloppy.
So it's really positioning, you think, that's going to power us through a small drawdown in August and eventually a strong end to the year?
Well, you know, there's positioning, but then there's also narrative adjustment. You know, we haven't been in the recession camp. So many thought earnings would fall apart sometime, and it hasn't. In fact, estimates are going up. So it's recalibration of the view plus their positioning amplifying that.
Tom, always good to see you. Thank you.
Yeah.
Tom Lee of Fundstrat. Time now for a news update.